want to dive in a little bit deeper to Elliott wave. The Elliott wave theory has 5 different waves. It's based on a trend reversal. So if you had a downward trend, broke out, the first leg would be an impulse wave, in this case uptrend. It would probably come into some resistance level over here on the downward trend, or back up into a Fibonacci retracement level off of the downtrend. After you hit resistance, you would get a pullback. The 3 main patterns that you'll find are flag pattern, pennant pattern, or a wedge pattern. Next thing you might see or hear about is a Gartley pattern, a bat pattern, some kind of harmonics, but don't get too anxious about that, because really the Gartley pattern just represents the 78 retracement Fibonacci level. Price goes up, then it comes back to the 78 Fibonacci retracement level before bouncing, going back up again. As you see with the bat pattern, it goes all the way down to the 0.88% Fibonacci level, just meaning price went up, hit resistance, and then almost came all the way back down to that lower support level. An alternative bat means that it went a little bit lower than that support level, but then from there should bounce back up higher. From there, you'll have leg 3, which is a phenomenal impulse wave. It is literally straight up. This is the moneymaker wave. After that, you'll have a little bit of resistance, pull back, and then the completion of the Elliott wave, the 5th leg, which a lot of times is around the same size as the first one or smaller. Now that you understand that, I'm going to take you to the next level. Within that first impulse wave, you will have a smaller Elliott wave, 5 legs going up into the resistance level. Then like we showed, you'd have an ABCD pattern or a harmonic pattern or a flag pattern pulling back, and that's your consolidation. In leg 3, you'll have a 5 wave. Leg 4, pull back, should be a smaller ABC pattern. And then leg 5, you'll also have 5 steps in that last wave. So when you hear somebody say buy the dips, they're talking about these consolidations and then move into leg 1, 3, and 5, because that's where the impulse is. So you know when people say the trend is your friend, that's basically what they're saying is you get the biggest move with the Elliott wave impulse trend is your friend trade. Once you figure out the 5 legs of the Elliott wave and then followed with the 3 legs of the ABC pattern, you'll know exactly where you are on the chart and how to trade that. Are you high? Are you low? Are you making a reversal? So general idea, when you're looking at a flag pattern, pennant pattern, or a fallen wedge, there's 3 points for that support level. So if you're going to buy the bottom side of the channel pullback, you'd probably want to wait for 3 bounces off of a support before entering into the trade. Otherwise, draw a line waiting for price to break above that resistance and then enter into the trade. Now, I have a quicker way to identify this. And let's just say that this is a moving average that's 200, 300. Something that gives you a long-term look at trend. Then let's say you print also a 150, 200 moving average. And that's where you'll see the consolidation come back down to before taking off. And then if we were to do something like a 30 or 50, it'd really amplify that impulse wave to let you see the Elliott wave formation. Now say this out loud. It's an idea. It's not perfect. I'm just trying to get your eyes honed into what happens with an impulse wave or an overall trend. All right, so you can see that prices come over the long-term moving average, giving us a nice uptrend. When it pulls back to the gold line, that is a longer-term correction leg on the Elliott wave. Pull back into the moving average, longer-term correction. See how long this kind of went sideways? Right here, back into this moving average. Then once it went over the impulse leg of the quicker moving average, boom, price shot up. Consolidation, consolidation. So we can get a quick look and see prices coming back over the blue line and impulse wave. Huge gains here. After that, we see price comes down into the long-term support level of the moving average, goes back up. If we duplicate this range box, take it down, I bet we have an ABCD pattern here. Perfect, right down to this lower level. Okay, what do we see? We see price coming over this lower moving average, impulse wave up. Once we break the impulse wave, we're looking for a consolidation. We have the consolidation, back into impulse wave, breaks below the impulse wave, back into consolidation. Can you guys guess what this one is? I'll give you a hint. It's around $900. Price breaks above here, impulse wave up, breaks below the impulse wave, goes down to that moving average, consolidation, breaks above the impulse wave moving average, consolidates below, but doesn't go all the way down to this moving average. That just means it's in a strong uptrend. Then we see the breakout, and that's an impulse wave. Now price is coming below the impulse wave, not to mention this nice little head and shoulders pattern right here. And so you should be taking your profits. Use your longer dated moving average for your trend. Use your 150 to 200 day moving average as a long-term entry level. Use your 30 to 50 entry level moving average for impulse wave. So when we look at Tesla and see this leg 1 with the pullback, big leg 3 with a leg 4 pullback, into a huge leg 5, which is around an ABCD pattern of this leg 3, coming into a completion with a head and shoulders pattern, falling below this impulse wave, using the tops of these resistance levels down to the moving average. This is 70% off the moving average. This is 79% off the moving average. And right now we're at 79% off this lower moving average. Do you think, based on the history of this thing being about 80% off these bottom highs, it's time for a pullback? Any edge you can get on understanding the movement of the stock chart will let you clue into what other people are doing, why they're doing it, where to take your profits, and where to let it run. Because there's nothing new under the sun, not even with stocks. Once you learn some of these fundamental principles, you'll be able to tweak your system so that it's just right, so that you can make the maximum amount of profit and not be so anxious about, should I stay, should I go, should I enter, should I wait? I'm going to see if you stayed to the end, because I'm going to give you a little trick. If Elliott wave is true and it happens all of the time, and you take these two highs, then that means you should be able to draw a resistance line off of those two highs to see where the Elliott wave should come into that resistance, so you can either take profits or buy to the downside. My highest point, my second highest point, leg 5 coming into resistance. One high, another high, price is coming right into resistance. Here's what I want you to do. I want you to go into your charts. This is homework. You have to look at the downtrend. We know when it happened. It stopped in March. So take from March and draw the Elliott wave up and see where your stock tickers are. Are you in a leg 4? Are you in a leg 5? Have you already pulled back and made the A leg to the downside ABCD pattern correction? If you can't see it by yourself, then go ahead and add the moving averages on there. And also, don't forget the high side resistance of the Elliott wave, taking the first leg high side, the third leg high side, and it should give you the target of leg 5. Ring that bell for more great information.